Hello all, welcome to Get Into IAS, and in this video we are going to deal with the chapter Indian Financial System and specifically Money Market. So now moving to the Adjusted Net Bank Credit. Fine, we are going to decode the word Adjusted Net Bank Credit. So net bank credit plus non-SLR bonds held to maturity is called as Adjusted Net Bank Credit. That is, what is net bank credit? So net bank credit is the difference between outstanding gross deployment of bank credit. See, if in case this year the bank has decided to give a loan of rupees 100 crore. So that is the outstanding gross deployment of bank credit at the start of the financial year. So at the start of the financial year, they decided to give a loan amount of 100 crore rupees. And at the end of the financial year, how much rupees have they lent? For example, say 150 crore they have lent to the people. So this is called as the net bank credit. I'll repeat, see, it's the difference between outstanding gross deployment of bank credit. See, the bank credit what they've decided is 100 crore. At the start of the financial year, it was 100 crore. But at the end of the financial year, what was it? It is 150 crores. So this is called as net bank credit. Now coming to the non-SLR bonds held to maturity. So what is non-SLR bonds? You know the term SLR, statutory liquidity ratio. Every bank should keep certain amount of reserve within themselves, that is within the bank. That is called as SLR. SLR can be of cash, gold or government securities. Same way, if the same reserve is kept with RBI, it is called as CRR. Fine. So under this SLR, the non-SLR bonds, for example, some bonds are classified to be kept under SLR. Some bonds are not classified to be kept under SLR. So bonds which are not qualified to be invested for the purpose of SLR stipulated by the RBI. RBI only will decide which all bonds will stay inside SLR and which all bonds will stay outside SLR. Fine. So the RBI classifies the bonds which are eligible to be under SLR and which are not eligible to be under SLR. Fine. Next, coming to the off-balance sheet exposure. What is called as off-balance sheet exposure? For example, it means the assets and liabilities that are not qualified as assets and liabilities at present but likely to become so in future. See, today I may have 50 rupees in my purse, but tomorrow I'll tend to lend this 50 rupees to someone else. So until I lend, that is not my asset. So asset is my loan. So until I lend, this 50 rupees is not my asset, right? So after I lend to the person 1, that is my asset. So later that person will pay back that 50 rupees, the principal plus the interest. So then only it is termed as what? Until the person pay backs that amount to me, that is the principal and the interest, then only that is termed as my asset. Until that comes to me, it is not called as my asset. So that is called as off-balance sheet exposure. I told you all, every bank has a balance sheet. The assets and liabilities are calculated in the balance sheet. Fine. So until the person gives back this 50 rupees back to me, that won't get accounted in my asset. Fine. So that is called as off-balance sheet exposure. So these are the two terms. That is, first thing is the adjusted net bank credit and second one is the non-SLR bonds and the third thing is the off-balance sheet exposure. So now moving to the next topic, financial inclusion. What is called as financial inclusion? It is including people into the financial system. You are bringing in a lot of people to the financial system. That is called as financial inclusion. Fine. So you are basically bringing the people into savings and receiving loans. Find that if I am not having any bank account, after opening the bank account, I save. So I deposit. After that, in case if I need to start a business, I tend to get loan from the bank. So this is bringing a person inside the financial system. Fine. There are two terms to be noted down. One is the no frills account and next one is the basic savings bank deposit account. What is called as no frills account? So under the no frills account, normally when you are going to a bank, see before 5 years to 10 years, you should pay for that. You should maintain a minimum balance in your account. So that is called as no frills account. That is, you should maintain a low to minimum balance in that account. So normally the no frills accounts was opened for poor people. So poor people normally they don't tend to open bank accounts, right? So for them, for the purpose of them, the no frills account was started. Next, what is basic savings bank deposit account? So under the no frills account, there should be low to minimum balance. But under the basic savings bank deposit account, you don't need to maintain any balance. So low to minimum balance, fine. No minimum balance is required. Next, for example, for this basic savings bank deposit account is the PM Jan Dhan Yojana. Under this, at least 2 accounts for a family was accounted, fine. So this is the kind of scheme or Yojana. Next, coming to the promotion of microcredit. Microcredit is a small amount of credit, fine. Small amount of credit to poor in rural plus semi-urban and urban areas. So giving small amount of credit to rural, urban and semi-urban areas is called as promotion of microcredit. Under this, they raise income level and improving the living standard of the people. So what they normally do is, why they should give a microcredit is, the income level of a person will be raised. See, I will need 1 or 2 lakh rupees for my business, for a startup. So that is called as a microcredit. So by that, I raise my income level by starting a business. Or for building a house, they will give microcredits. So they improve the living condition of that person. So that is called as promotion of microcredit. So for this, we have various microcredit institutions which provide microcredit loans to the people. Next, coming to the Basel norms. So Basel norms are fixed by the Bank for International Settlement. So Bank for International Settlement fixes the Basel norms, which is located in Basel, Switzerland. So Basel is a place in Switzerland. So over there is something called as Bank for International Settlements, BIS. Fine. Okay. Next, these banks operate internationally. So the Bank for International Settlement, they operate internationally throughout all the countries. Fine. So there is something called as SIFI. So what is called as SIFI? So systematically important financial institutions are called as SIFI. In case, see, if there is a bank in India and that bank accounts to be the SIFI, systematically important financial institution, the failure of this bank will cause failure of all other sectors which is depending on this bank. So a lot of people may be getting loans from this bank. So the failure of this bank will result in failure of other sectors also. So SIFI is what? Failure may trigger a large failure within the financial sector. Fine. So this is called as SIFI. So under this, the financial institutions, normally the financial institutions they are referring here will be very big in size. So the size of the financial institution or the bank will be very big. They receive short-term funds, give long-term loans. So see, there will be a mismatch of liquidity. See, for example, if there is a financial institution, this financial institution is getting short-term loans through deposits. See, I am depositing my amount for 1 year term. So after the 1 year, I will demand the deposit what I deposited in this financial institution. Later what will happen, after getting the money from me, this financial institution, right, they will lend long-term loans to infrastructure projects. For example, building of roadways, highways. So all those projects will take 10 years to be constructed. They will pay the principal and the interest after the 10 years. So before that itself, this financial institution should pay whom? This depositor. It should pay me. So there is a asset liability mismatch. So asset is the loans given and the liability is the deposits taken from me. So there is a asset liability mismatch. So this is called as what? A big institution. So normally it is big in size, they receive short-term funds and give long-term loans. So these are prone to failure. So when they give the short-term, so when they receive the short-term funds and give the long-term loans, they are prone to what? Failure. Next, coming to the Basel norms. So these norms are developed by the Basel Committee on Banking Supervision. Fine. So under this we have 3 kinds of Basel norms. Basel norm 1, 2 and 3. So Basel norm 3 is under process over here. So what is Basel norm 3? So under this, to improve the banking sector's ability to absorb shocks arising from financial institution. See, if a large financial institution fails, it leads to the failure of other sectors also. So to absorb this shock, there should be various precautionary measures. So that is recommended under Basel norm 3. Next, to improve risk management in the financial institutions. Third one, to strengthen banks' transparency. I already told you transparency means that publicity. Fine. Next, coming to Basel 3. Under the Basel 3, we have 2 important terms. One is the capital, another one is the liquidity. So under this, we have 3 pillars. That is, under capital, we have capital, risk coverage and containing leverage. Second pillar is risk management. Third pillar is market discipline. Fine. These 3 are the pillars under capital. Fine. Now coming to the pillar 1. Under the pillar 1, we have the subheading capital, risk coverage and containing leverage. Fine. So first thing, the quality of the capital will deal with the quality and the risk weighted asset. Fine. So under the pillar 1, they're telling how the quality of the capital should be maintained. So what is a capital over here? The word capital denotes, see, in a bank, normally the capital will be like the depositor's money. I am depositing my money inside a bank, right? So that is the capital for the bank. Why that is a capital? Because using that amount only, they will lend to other people. So my money, the depositor's money, will be used to lend loan to others. Fine. That is why it is called as capital. So it is the capital. So this depositor's money is used to give loans. So this becomes asset. But the depositor's money is the liability of the bank. That is, the bank has to repay the amount. So on the whole, clubbing everything, that is the liability and the asset of the bank, that is called as the capital. Fine. So under this, the total capital to risk weighted asset ratio should be 8%. We already dealt with the CRAR or CAR. So under that, the CRAR should be maintained at 8%. So this 8% is split into 2. Fine. This 8% is split into tier 1 capital of 6% and tier 2 capital of 2%. Fine. So under the tier 1 capital of 6%, that is furthermore split into 2. Over here you have the common equity tier 1 of 4.5% and additional tier 1 of 1.5%. So totally 6%. Fine. So all these capitals should be maintained by whom? By the banks. Now we'll deal with the tier 1 capital. In tier 1 capital, we have something called as the share capital, and you have to know about the disclosed reserves. So what is called as the share capital? See, we all are going and investing in a bank. Fine. Our money is deposited inside a bank. So that is a share for us. The bank has to return that back to us. So that is called as the share capital. Fine. So that will come under the tier 1 capital. Next, coming to the disclosed reserves. Disclosed reserves is the after paying the taxes, the remaining amount. See, the banks also has to pay certain amount of taxes, right? So after paying all the taxes, there will be remaining amount. See, if in case I am earning 100 rupees, fine, I am paying a tax of 10 rupees. The remaining amount in my hand is 90 rupees. So this is my disclosed reserves. Fine. So this disclosed reserve of 90 rupees, I will use it for the further investment. Tomorrow I may buy something with this 90 rupees. So that is called as disclosed reserves. Fine. It's used for future growth. So all these, that is the share capital and the disclosed reserves, will come under the tier 1 capital. So this is common equity tier 1 of 4.5%. That is the share capital, and the disclosed reserve should be maintained at 4.5%. Next, coming to the additional tier 1 capital. What is called as the additional tier 1 capital? See, the banks borrow. Fine. The banks borrow. The borrowed amount is the debt of the bank. Fine. So the banks normally borrow. That borrowed amount is the debt of the bank. Fine. So they do not have the maturity period. This debt do not have a maturity period. See, for example, there is a bond here. I am purchasing this bond. Person 1 is purchasing this bond from person 2. Fine. So after certain period, this person 2 has to repay back the money to me because he borrowed it from me through the instrument called as bond. And when will he repay that money back to me? There is certain maturity period for that. Say 1 year, 2 year or 3 year. Fine. So this is the maturity period. But under additional tier 1 capital, the bank is borrowing certain amount, right? That amount has no maturity period. It is the bank's wish. Bank will decide when they should pay that amount to the borrowed person. Fine. Next, coming to the tier 2 capital. So we've dealt with the common equity tier 1 and additional tier 1. 4.5% and 1.5%. Now coming to the tier 2 capital. Fine. So under tier 2 capital, how will the banks maintain that? See, it is the opposite of the additional tier 1 capital. So same way, it has a maturity period of at least 5 years. Same way, the bank will borrow money, that is a debt for the bank. It has to repay after a certain period. That repaying period is 5 years. Within 5 years, it should repay it back to the person. So that is called as tier 2 capital. So the banks are borrowing in two kinds. One has a maturity period over here, that is called as tier 2 capital, and the tier 1 capital, additional tier 1, doesn't have a maturity period. This is how the banks will maintain the capital. Fine. Now over and above this 8%, so this CRAR or CAR of 8%, banks has to save some more. So that is called as capital conservation buffer. How much it has to maintain? 2.5%. All this is the recommendation of the Basel norms, Basel 3 norms, fine. So capital conservation buffer is how much? 2.5%. For what are they maintaining this capital conservation buffer? See, the banks or the financial institution will undergo a financial stress at certain period of time because of the asset liability mismatch, fine. See, certain banks, right, they will lend long-term loans, but they will receive short-term deposits, fine. So the short-term deposits, they should pay back within 1 year or 2 year period. But this long-term loan, they have given to some other person for 10 years. So for this person to repay back this loan amount, it takes more than 10 years. But the bank has to repay all these amount which has a maturity period of 1 year to 2 years. So there is the asset and liability mismatch here. So the bank will be normally under the financial stress. So during this financial stress, it can use the amount, it can use the capital which it has saved in the capital conservation buffer of 2.5%. It can utilize this amount. So that is called as capital conservation buffer. So all these methods are used to save the bank from the stress in future, fine, and to maintain the sound financial system. Next, coming to the credit bubble. What is called as credit bubble? See, normally the bank's balance sheet most of the time it will be burst, fine. So to bring in a proper balance sheet, the RBI has brought in the term credit bubble. What is called as credit bubble? See, during the period of high credit growth, what is high credit growth? See, normally the banks will tend to give more amount of loan. If it give more amount of loan, then it will get a lot of assets, right? So it will get principal plus interest. So with this, again it can lend to someone else. Again with that amount, it can lend to someone else. So this is called as money multiplier, fine. So with this, it can multiply a lot of money. From 100 rupees, it can multiply to 1000 rupees at a shorter rate, fine. So this is called as high credit growth. Lending loans at a faster rate is called as high credit growth. So what the RBI has done to check this, RBI will stipulate additional capital requirement to avoid the credit growth. See, these are the capital requirement. Banks has to take certain amount and keep it as a reserve. That is the capital requirement. What the RBI will do to check this high credit growth, it will tell the banks to take certain amount and keep it as a reserve. That is the capital requirement. Fine. This is called as counter-cyclical capital buffer to make the banks not to lend more. Fine. So this is called as what? Counter. It is countering the bank not to lend, not to give a high credit growth to the people. That is called as what? Credit bubble created by RBI. RBI only will stipulate the capital requirement. Now moving to the leverage ratio. So what is called as leverage ratio? Leverage ratio has a formula, that is capital measure divided by exposure measure. What is capital measure? Capital measure is the tier 1 capital. What is tier 1 capital? We already dealt with that. Tier 1 capital is 6%. One is the common equity tier 1 of 4.5%. Additional tier 1 of 1.5%. So you can write it here. Common equity plus additional tier 1. So that is what? Tier 1 capital. So I'll recall it. See, under tier 1 capital, under the common equity, you have share capital, that is the investors who have invested in the bank, and next one is the disclosed reserve, that is after paying the tax, there will be certain amount of money that will be used for the future growth. That is called as the tier 1 capital. In additional tier 1 capital, you have the bank that will borrow, that is a debt for the bank, but the bank can pay the money at any time because it doesn't have the maturity period. So this is the tier 1 capital divided by exposure measure. What is called as exposure measure? See, assets created by the bank is called as exposure measure. Assets is the banks has lent loan to a lot of people. That loan has been repaid, that is the principal and the interest has been repaid. That is called as exposure measure. How much the bank has lent, how much the bank has created the asset. That is called as what? Exposure measure. So the leverage ratio is the capital measure divided by exposure measure. This is the formula. Normally the bank should maintain a leverage ratio of 3%. So this should be 3%. So now moving to the pillar 2. Pillar 2 is the risk management and supervision. So under this, RBI will review the banks. What and all the RBI will review is the capital adequacy, how much it has maintained the capital, the risks, that is the non-performing assets of the banks, and to devise the risk management. So what and all risk has arisen, it will give ways to devise risk management. So this is called as risk management and supervision of RBI. Next, pillar 3, we have the market discipline. See, disclosure of certain details like capital adequacy, risk exposure. In case, so a disclosure of certain details like capital adequacy and risk exposure to maintain the transparency in the banks. So this is brought about by RBI. So this is pillar 3, that is the market discipline should be maintained by the banks. But under the risk management and supervision, RBI will take over the banks for review. Next, coming to the liquidity. Fine. So under liquidity, you have the liquidity coverage ratio. What is called as LCR? Very important. What is LCR? Liquidity coverage ratio. So normally, if I'm having rupees 100, I can easily go to market and purchase things. Fine. So this is my liquidity. The total amount of cash I hold in my hand is my liquidity. See, if I'm having gold, this gold, I can sell it in the market and get easy cash. So this is also my easy liquidity. Fine. So in case if I have something that which is not easily liquidated, for example, take the same gold, if the gold is not being sold in the market, if no one is willing to get that gold, that is not easily getting liquidated. So this is a risk factor for me. Fine. Same way, banks has to maintain certain amount, the liquidity, that is called as liquidity coverage ratio to tackle the risks. Fine. So adequate high quality liquid asset, that is why it is called as high quality liquid asset in cash form. Fine. Means it can be converted into cash easily in private market. So if the banks are here, the banks are willing to liquidate certain gold in the private market, they can easily get the cash. Fine. So that is called as liquidity coverage ratio or high quality liquid assets. Fine. So this high quality liquid assets should be maintained for a period of 30 days to suck in all the risks. Next one, coming to the net stable funding ratio. So there are two types of liquidity. First one is LCR. The next one is the net stable funding ratio. What is called as net stable funding ratio? See, under this, it is the ratio between available amount of stable funding divided by required amount of stable funding. What is available amount of stable funding? So banks will be maintaining certain amount, right? So that amount, it should be able to give as a long-term loan. So if the banks give long-term loans only, what will happen? Infrastructure will be created in our economy. So long-term loans are very essential. Fine. So that is called as available amount of stable funding. It should have that available amount to fund for the long-term loans. Fine. Next, coming to the required amount of stable funding. What is the required amount of stable funding? See, we are going and depositing in the bank. Fine. So we are the depositors. And banks will borrow from the market also. So later at a maturity period, the bank should repay the borrowed amount and it should give back the amount that the depositors has deposited in the bank. So fine, these are the liabilities of the bank. So this liabilities should be paid back by the bank. For that, it should have certain required amount within itself. So the required amount of stable funding. So this is the ratio. The ratio between these two is called as net stable funding ratio. Fine. For net stable funding ratio, the liquidity should be fine. So next, coming to the topic of non-performing asset or NPA. So what is called as NPA first? NPA is the installment of principal or interest if the installment of principal or interest remains due for a period of 90 days. See, in case if I am getting 100 rupees loan from a bank, fine, the interest for this is 10%. Fine. So totally I should be paying 110 rupees to the bank. Correct? In case within the first 90 days of me getting the loan, if I didn't pay even a penny of the interest or the principal amount here is 100 rupees and the interest amount here is 10 rupees. In case if I didn't pay any of this, not even a penny within this 90 days, that is termed as a non-performing asset of that bank. So there are two terms to be noted down here. One is the gross NPA and next one is the net NPA. I'll let you all know about the gross NPA. Gross NPA is the total amount of NPA divided by total loan advances. Total amount of NPA is calculated like this. So how much amount of NPA each person is withholding. Next one, total loan advances is the total amount of loans given to the various individuals, companies or corporates. See, if 8% is the gross NPA, for example, take 100 rupees, 100 rupees loan is lent, 8 rupees is the NPA here. So the gross NPA is termed to be 8%. I'll repeat. How is the gross NPA calculated? if 100 rupees loan is being lent, in that if 8 rupees is the NPA, non-performing asset, so 8 rupees becomes the gross non-performing asset here. So from this formula, this 8% is derived. Fine. Next, moving to the types of NPAs, non-performing asset. There are 3 types of NPAs. First one is the substandard asset. So if the principal or interest is not paid within 12 months, more than 90 days and within 12 months. If the NPA is not paid more than 90 days and less than 12 months, it is called as substandard asset. What is doubtful asset? So under doubtful asset, if the principal or interest is not paid within the 12 months, that is, if it exceeds more than 12 months, that is 1 year, that is calculated to be the doubtful assets. Next, coming to the loss assets, that is, the banks will know that this specific individual or the corporate will not pay the money back, that is, they will not pay the principal or the interest bank. That will be termed as the loss assets, that is, it will be recognized by the auditors of the respective bank. So, under the substandard asset, doubtful asset, loss asset, we have a term called as provisioning. What is called as provisioning norms? See, according to the NPA, certain amount is set aside by the banks. That is called as provisioning norms. See, for example, if 100 rupees loan is lent, fine. If the NPA keeps on increasing, the banks has to set aside certain amount within their purse. So, if the NPA is increasing more and more, this provisioning amount also will increase more and more. Fine. Depending upon the NPA only, this provisioning amount of the respective banks will increase. See, if the provisioning amount increases, the bank's lending capacity will decrease because this amount will be locked inside the bank's locker. Fine. So, this provisioning amount should not increase, but that depends upon the NPA. Fine. See, the provisioning norms for various assets is calculated. For example, under substandard asset, the provisioning amount is 15% of the total loans. Under the doubtful assets, it is 25% and it keeps increasing. Under the loss asset, if I give 100 rupees as loan, I know I won't get back the 100 rupees, and hence my provisioning account will be 100 rupees. I should store 100 rupees inside my provisioning account. These are called as the provisioning norms. Fine. Now coming to the net NPA. So under the net NPA, it is the gross NPA minus the provisioning. I told how to calculate the gross NPA minus the provisioning. Provisioning is the amount set aside by the banks depending upon the types of NPAs. So under the gross NPA, it is used to calculate the asset quality of the bank. They are seeing the asset quality of the banks. So what is the asset of the bank? The loans given to the people are the assets of the bank. They will see to that the NPAs does not increase. So the asset quality of the bank is calculated using gross NPA. And net NPA is the total burden of the bank. See, the provisioning amount here is calculated. See, the provisioning is minus, and hence the burden of the bank by minusing the provision from the gross NPA is being calculated. Next one is the slippage ratio. What is called as slippage ratio? It is the percentage of fresh NPA as percentage of loans from beginning of the quarter. See, take 1 quarter. The financial year, the first quarter is from March to May. Under this, the total loans lent will be rupees 100, but the NPA is 10 rupees. 10 rupees the bank hasn't got back. So that is called as the NPA. So the slippage ratio will be 10%. So how much ever amount the loan has been given, from that the NPA will be calculated. From this percentage will be calculated. 10 in 100 rupees is 10%. Fine. 10 rupees in 100 rupees is 10%. So the slippage ratio of the respective bank will be 10%. So this is all about NPA. So we've done with the lesson Indian Financial System, Money Market, and that's it for the video. Thank you for watching, and please subscribe to Get Into IAS and follow our channel link in the description box given below. Thank you for watching.